This is video 7 on example 11 dealing with the category financial liabilities at amortized cost. We are now at the last financial year, which is 31 December 2013. The first entry that we need to account for is the finance cost. At the end of that year, interest has accrued. Debit finance cost, credit the liability with that interest. How do we calculate that interest? Well, we are busy with the effective interest rate method, which means we take the balance on the T account as it was for this entire year for the period that accrued interest. How much was the balance on which we have to calculate interest, the outstanding balance, and we multiply that with the effective interest. In this example, we had to go and calculate a new effective interest because of transaction cost. You bring in the interest and then you take out the payment. So that is the next journal entry. It is the payment of the interest at the end of 2013. How do we calculate the cash flow, the payment, the bank amount? Nominal value times nominal rate. Just remember, half of the debenture had already matured, was already repaid. That part won't accrue interest. The issuer won't be paying interest on a part that was already repaid to the investor. It's on the outstanding balance that we pay interest. So credit bank with the interest, debit the liability because we reduce it with the payment. That was, however, not the only payment that happened on 31 December 2013. The last payment that happened is the final maturity payment. That final maturity payment is credit bank with the 550 that we already calculated and debit the liability. Reduce the liability because you are making a payment. Now, if you worked correctly, your debenture should now have a remaining balance of Rand because it has matured. You have paid back everything. You should not owe your investor any amount anymore. So if you worked correctly, you would now have a balance of R0. Sometimes there's a few cents left just because of rounding, but it should be very close to R0. You can always draw the T account, put in all the entries and see that the liability works out on R0. Otherwise, you can just take every single journal into account. Your debenture has matured. Your issuer, Annika Limit, owes nothing anymore to the investor. They have repaid the entire debenture. There is nothing left that will be on your statement of financial position. Now, for debentures, either on the asset side, the investor, or on the liability side, the issuer, we can expect you to do journal entries, we can expect you to do calculations, we can expect you to answer a theoretical question, we can expect you to do T accounts, and we can expect you to present this item, the debenture, on any of the financial statements. Present it in the SFP. Present the amounts applicable to the debenture in the statement of profit and loss and other comprehensive income. So we can ask you to present it. What we won't ask you is to do the investment in debenture or the debenture liability note in the financial statements. That you do not need to know because that is a separate IFRS. It's IFRS 7 that only deals with disclosure, and that falls outside the scope for us.